Hey, this is Evan Hutchison, CPA, wanting to go over kind of a mixture of things. So, in the past, I usually go over how to do certain things, whether it's bookkeeping or cash flow management or tax return, tax prep, tax strategy. Here, I want to create something that runs through kind of the whole process of everything from deciding to open a business to setting up the company's books, to doing some books, to doing the tax return based on those books, and setting up some maybe future tax strategy. So my plan or my hope is that by watching all of this together, and of course I'm going to have to do it in an abbreviated fashion, but in watching it all together, you'll have a better or a stronger understanding of how everything's kind of tied together and how everything's pieced together, and you can use that to make better decisions in the future. So this is just a random example. I'm just creating this lady Maria who wants to become an entrepreneur. She goes out on her own. She wants to set up her own business, and typically when a person does it, they want to set up an LLC or an S Corp, but there are different options. You can do an LLC, you can do an S Corp, you can do a C Corp, you can do a sole proprietorship, and you might want to do a sole proprietorship if you're not completely confident about the business yet. Maybe you're just starting and it's something low risk, or maybe it's just a little side hustle you're doing and you just want to do a sole proprietorship. You may want to do a C Corp if you want some angel investors to be attracted to a startup that you're creating, or something of that nature. But typically you want to do either an S Corp or an LLC. And depending on the state you're in, you probably want to do some research to try to determine what the best fit is for that state. In Tennessee, you'll have attorneys tell you that S Corps are better, and then I think LLCs are usually better. You have to do the math, do the calculations, and see where the tax benefits are. But don't just strictly listen to an attorney. Do your own research and then use your attorney as some backup guidance, or your CPA as some backup guidance. Of course, I'm thinking strictly from a tax standpoint, but a lot of attorneys here think even from a tax standpoint, S Corps are better, but at least in Tennessee, S Corps are required. The income is hit with excise tax, and the LLC's income usually is not. We usually get that excluded. So even with paying yourself a reasonable salary as an S Corp and the leftover amount not having to be hit with self-employment tax, an LLC is usually better in the state of Tennessee. Usually. You can do some break-even analysis to figure out which would be better in your situation. All that being said, this lady Maria, she's deciding to set up a service-based business in Tennessee and setting it up as an LLC. I want to go this direct path because so many times I write blogs or I do videos of different trying to explain different variables in different situations. And I think maybe in this situation, since we're going over so much in such a little amount of time, doing a strict example might be better, a specific example of a specific individual, and you can learn some direct things from this example, and you can deduce some indirect things. But if I try to go in all these different angles and perspectives, I have a feeling I won't be able to get as much done and be able to help you out as much. So let's just say Maria wants to set up an LLC in the state of Tennessee. It's a service-based business. The first thing she wants to do is to create an LLC with the Secretary of State. So to do that, I put up a few websites here. This is the Tennessee Secretary of State's website. She can search the name she wants to set up the business and make sure it's available. And once she does discover that it is available, then she would just go to business services, and you can type in starting a business in Tennessee, but or you could Google Tennessee Secretary of State and just go to business services, business entity filings, in her case LLC, which that didn't work, did it? LLC, limited liability company. and then you can go to the form or register a new business right here, and it'll walk you through the process. So you go through this process, and then you set up that's this same business with the IRS. So you can Google employer identification number IRS or register a business IRS. This is what pops up. So you need to apply for this employer identification number after you do the Secretary of State filing. The Secretary of State is first. That's how you register your business as an LLC. Then you set up this the EIN with the IRS, and then you would go to your state's Department of Revenue's website and set up tax registration. So in Tennessee, this is the TIN-TAP website. You can register a new business right here, and then you can create a TIN-TAP account and add this business you just registered to TIN-TAP. And that's where you can keep up with all your filings and everything of that nature. So you have the Secretary of State filing, the IRS filing, the Department of Revenue filing. Then you usually, depending on what county you're in, most counties in Tennessee will require a business license, so you'll use this Department of Revenue filing, because one of the things you have to file for is business tax with Tennessee. But that business tax is really, it's administered by Tennessee, but it's paid to the county and the city. So then you'll go to the county clerk and actually get the business license and give them your information from the Tennessee registration. So you'll have a Tennessee Secretary of State registration, Tennessee Department of Revenue registration, Internal Revenue Service registration, and a county registration, those four things. Once you do that, your next step, I mean, you don't have to go in this exact order. What I like to tell people to do when they're starting out a business is, even though this is going to change dramatically, even in the next few days as you get going, because you learn so many things, you discover new obstacles, find new opportunities, all this stuff is going to happen within the next few days, weeks, months, and years of starting your business. But you want to start out, I think, by having some sort of vision in place. Whether that might be a 10-year vision, just where you want to be in 10 years. You should always have that and always fight to get to that position. So if you have 10 years, then you can narrow that down to 3 years and determine what you need to do within the next 3 years for your business to get to that 10-year goal. And you keep narrowing it down. So you figure out what needs to happen in 3 years, then you figure out, in order to get to that 3-year mark, what do you need to do in the next year? And finally, in order to get where you want to be in the next year, you create some objectives for each quarter. So you want to do those as quickly as possible after starting your business, just so you want to get off on the right. You want to really think about the processes in place and everything and get off on the right foot. And of course, part of the reason you're only doing it a quarter at a time is because it's easier to manage, and also because after 2 quarters you might realize your vision changed a little bit. So you change that up and you adjust your quarterly to-dos. So I would suggest start out with create some first quarter of your business to-dos, maybe 3 to 5 of them, and those are going to be something that you're kind of working on the business while you're trying to collect revenue and pay expenses and everything like that. So you're constantly working on your business while you're working in your business. But part of working in the business is doing the bookkeeping and the taxes. That's kind of what I wanted to move forward with and go over really quickly. I would suggest, everybody's different. Some people might want to just use Excel, but QuickBooks is a great tool to use for bookkeeping. There are other softwares out there that might work better for your specific industry, but QuickBooks is a pretty good catch-all software, and you can set stuff up pretty easily with it. So there is a self-employed edition of QuickBooks, which I do not suggest unless you're just doing something you're not really paying much attention to on the side. It's just a little side hustle. You can use that. But if you really want to get into your business, which I would think if you're watching this video and you're Googling things on the internet and you're trying to figure out the best ways to do things, you probably do want to set up a successful business. If you do want it to be successful and you want to focus your energy on it, then don't get the self-employed version of QuickBooks, because that's going to start you out. It's going to be really, really simple to start, but it doesn't have the potential for growth. It doesn't even have a balance sheet, and a balance sheet is very important to see where your equity is in your business. So I would suggest one of the above tiers, whether it's the Essentials version, the Plus version. You probably don't need the Advanced version, but you can look at the tiers and what they offer, and just determine which one's the best fit for you. So I just set up. I have this QBO right here. This is just an old QuickBooks file I have, and I wanted to go over kind of the process of doing the books. The first thing you want to do is go to the accounting chart of accounts. When you set up an account, it'll give you a template. But what you'll discover is you'll want some accounts that are not in the template. You might want to clean up some of those accounts that are in the template that you know you'll never use. Just declutter it a little bit. So you're going to delete some accounts, add some accounts. Once you get all that going, you're going to start importing the bank feed. And this is a really quick video. I want to go over some other things that I think might be more important than this. I go over the bank feed and the chart of accounts a little bit more on my bookkeeping video. But when you're importing the bank feed, you're drawing your bank transactions into the books and putting them in the correct account. But I just want to go over the process of bookkeeping from the ground level a little bit more. I have this, let's see, what do I have? I have this financial statement spreadsheet that I just wanted to show you. And what I want to do is kind of go through the process of, let's say this person did not start from scratch, Maria. Let's say she already had accounts receivable, cash, accounts payable, a customer prepayment, and this stuff. I want to show you how you can kind of add this into QuickBooks. This is more, we're getting into the land of accounting rather than bookkeeping. And I think usually you want to have a CPA to do your accounting, but sometimes as a bookkeeper you'll have to do some accounting too. So we want to put this in, even though it's not going to be from a bank import. And then we're going to look at this and these simple transactions and how they can be added to QuickBooks as well. So the bank import would be like this right here. You bought some supplies for $100. You go to the bank import and you see Office Depot $100, and you add it to office expense, or you add it to supplies in this case. It's as simple as that in QuickBooks. It does this transaction for you when you add it. But I want to show you kind of the fundamentals of this so you can understand it a little bit better. But first we want to input this journal entry. Let's say she currently has this income right here, this P&L, and this balance sheet. And to understand the balance sheet and the P&L and bookkeeping a lot more, I also have a video that's about accounting theory and how we came up with the debits and credits and why that's necessary. So it might be worth watching that too. I think that would be a big help. But here is the journal entry we're going to do. And I'm going to move this over so I can show you the QuickBooks screen, but we're going to add $20K to cash. Accounts receivable will be $9,000. AP will be $1,500. Customer repayment. And I got to admit, just kind of threw this together. But part of the reason I threw it together is so we can kind of go through it together as I struggle through remembering what I did. I think that might help you understand, or it might make you a little impatient at the process. If so, I'm sorry, but we will do this as quickly as possible. So these are the transactions we need to input. I'm moving it over right now, and I'm going to do it. We're going to do a 12/31 journal entry. That's the quick way to add a transaction into QuickBooks. Rather than, we can do one journal entry to add the whole financial statement into QuickBooks rather than adding all the different transactions. That's sometimes what you want to do when you're starting out, or you just need a quick financial, and then you start adding the necessary transactions afterwards. So remember, cash was 20 grand. Well, first we're going to change this to 12/31/2019, right? And then we're going to say cash 6350, $20,000. So cash is an asset. Assets Everything besides equity, and the accounting theory, I go over this a lot more detail, so I'll just have you watch. I don't really want to get into the whole process of debits and credits right here. Just watch the accounting theory or the basics of bookkeeping videos that I have, because I'm trying to just go through this pretty quickly. But assets are increased by debits. So we're increasing the asset of cash by debiting it for 20 grand. Accounts receivable, I don't even know if we can add an accounts receivable in here without doing an actual invoice, but we're going to try. So that's what I'm saying. I'm kind of going through this with you. We don't even have an accounts receivable account, but we just want to add an accounts receivable. Honestly, if we really want to get the books right, then I probably shouldn't do that. Let's do this. We're going to put an A, because we put the accounts receivable in there. Well, you know what, we can try it. We'll see what happens. $9,000 debit is an increase to accounts receivable. We'll say it's from Johnny. And then accounts payable. See, I think we might get rejected. Accounts payable. The account type is an accounts payable. This is what you owe somebody. We owe somebody $1,500. Customer prepayment, that's what somebody paid you, but you have not earned it yet. Customer prepayment, it's like an accrued expense. Or I'm sorry, accrued payable. Customer prepayment, we'll have to add that. So we can add that as a current liability, because that's money you received that you have not earned. So it's a liability. It's not really income yet. And liabilities are increased by credits. Assets are increased by debits. Liabilities and equity are increased by credits. Revenue is increased by credits. Expenses are increased by debits. One way to look at it is equity is increased by credits and decreased by debits. The P&L is a part of equity. It all flows through to the equity, which like I said, I explained this in a lot more in depth on another video. So the P&L revenue increases the P&L. So it's a credit, and expenses are debits. Expenses are debits, revenues are credits, equity is increase in equity is credit. And then assets are debits and liabilities are credits. It's something that you really want to remember when you make journal entries and that sort of thing. So the customer prepayment is $1,000. They owe $1,000. They've received $1,000 but have not earned it yet. Maria, I should say. And then we have the equity. She had contributions of what? We'll say equity contributions. That's what we're calling this account. And it is an equity account. She had contributions of 10 grand. Let's try to do this one more time. 10,000. All right. And she had distributions of, that's equity as well. And like I said, equity is a credit, but equity distributions decrease equity. So therefore, this is going to be a debit. Distributions, she's lowering her equity by distributing money back to herself. And then, so that's the balance sheet as you can see right here. I just put these in as debits, these in as credits, this in as a debit. This actually comes from the P&L. So the P&L is an extension of equity. But the reason it's a P&L, it's its own statement, is because it's an extension in order to make the balance sheet really messy. We throw it on another financial statement called the P&L. It's a separate, it's just a separate statement for purposes of ease. But really, it's part of equity when you get into the fundamentals of accounting. So we're gonna credit this and debit this to come up with net income of this, 18.5. So we're crediting what? Revenue, income, whatever it might be called in this set of books. Income maybe, yep. We're crediting that 153,500. We are debiting materials, which is a cost of goods sold. I'm not doing much with the detail type. It doesn't usually matter unless you categorize it a certain way. I've never had an issue with that before, so I'm just not gonna mess with it right now. Materials are 10 grand. Labor is another cost of goods sold account, and it is what, $35,000. And then we have, I just grouped all operating expenses into one. We'll just call it supplies. Supplies are $90,000. See how the last thing you do, it kind of gives you the right number in order to make it balance. And that's what this is. So you can see from this spreadsheet, 153 of income, 10 of supplies, 35 of labor, and then 90 of operating of supplies that we're just putting under operating expense. So we don't have a really large example. So that's that. So now we can save it, and of course it's saying when you use an AP you must choose a vendor. Who's our vendor going to be? Johnny number 2 is not a customer, he's a vendor because we owe him money. Let's try that. Okay. So now if we run a report for last year, we have this report which matches the balance sheet I showed you on the spreadsheet. So that's a quick way to input a balance sheet and a P&L, but then we want to go through it and we want to make sure that we understand everything from the transactions, the other transactions. So basically we're saying those are transactions. That's what the profit and loss looks like for 2019. This is what the balance sheet looks like, but we haven't input these yet. And what happens, like I said earlier, in QuickBooks and probably most other softwares these days, you're gonna connect your bank account, and the bank account is gonna show $100 paid from supplies. And you push a little button, and the supplies automatically get debited to expense. The cash automatically gets credited to cash. It does that automatically, but it's good to know it's good to know this process, because a lot of the QuickBooks and other softwares will do a lot of things automatically. But if you don't know the fundamentals behind this and you need to make adjustments, you're pretty much screwed. So you want to understand how it works, and that's what I'm trying to show you here. So we put this in already, and instead of doing the bank import, I'm going to show you how to do this directly. We're going to create this journal entry, create this entry, create this entry, create this entry, and you see what's going to happen, right? The balance sheet is always going to balance. The cash is going to go down 100 right here. And I guess it shows where we're off right here. That's the difference. So that should always be 0. So the supplies, we just increased that by what, $100? So this needs to, this net income amount should be this minus this minus this. And that's not showing up. Okay, let's try this one more time. I'm sorry. This should be equals income minus cost of goods sold minus operating expense, 18,400. So every time a transaction is made, the balance sheet automatically balances. If it doesn't balance, you know something's wrong. Like just then. I wasn't doing my simple math properly. So that's going to happen. Then the AR is going to increase. Remember, assets are increased by debits. Revenues increased by credits. So the AR is going to increase when you send out a bill for somebody that owes you money. So now we send out a bill to Johnny. He owes us $1,500. So our AR is $10,500, and our revenue on the accrual basis is $155,000. Now we decide we have some money in the account. We want to get paid. We want to pay ourselves. So we take out $1,000. We debit equity, and we credit cash. And then we collect on this receivable right here. So we take out the $1,500 and we add it to cash. And then we buy a piece of office furniture, or which we're grouping in this account called supplies or operating expense, just to make this easier. So we add $350 here, and we paid it down with a payable. We didn't pay cash, so we need to add to our payable. And then there's a customer prepayment. We earned our money. So remember, a debit decreases liabilities. That means we're decreasing the prepayment, which means we actually earn the money. So it's no longer a liability. It's now revenue. So we earned the money that we already received. So we can just wipe this out, right? Just wipe that out. And then we'll add it to revenue. And this is what the final product looks like after we make these journal entries. We're showing $29,400 of assets, $1,850 of liabilities, $27,550 of equity, and our net income is $2,550. So of the $27,550, $7,000 is related to money that we put in, or money we put in minus what we took out, and then the remaining $20,550 is related to how we did on an operational basis. So remember, the P&L is really a part of equity. We're breaking it into two financials so that we can make better management decisions, and just so the balance sheet won't be a mile long. So now what we want to do is I'm going to move this back over, and we're just going to input those transactions as quickly as possible. So cash and supplies, that would be what? That would be an expense or a check. Let's say we just paid it by check. That's fine. Category would be the expense account. So that's $100. And then we just save and close. The next one is AR. We created an invoice for $1,500. So where is invoice? Customer invoice. Let's say we only have one customer, and it's that Johnny fella. We just do Jon, Johnny, and we don't even have anything listed under here. You created products and services in your QuickBooks. We're not going to do that right now. We're just going to do this really quickly. That's $1,500 that Johnny now owes us. So we can save that. And now we're distributing some cash. That's the third thing that we decided to do. We're distributing $1,000 because we want to get paid. I say we, I guess I mean Maria. Maria is distributing $1,000. There's different ways you can do that. We can do a journal entry, or we can do an expense. Even though it's not an expense, we can just do an expense and just put it towards equity. Let's do a journal entry just to go a different route this time. She is paying herself $1,000. So this is going to be what? Equity distribution. $1,000, and then checking account $1,000. So we're crediting the asset, we're debiting, so we're decreasing equity by debiting it, we're decreasing the asset by crediting it. There is, what else is there? There's an office expense. Oh no, there's also the payment received from the accounts receivable. So we could go to sales, customers. We have Johnny. Did I do 10,500? I meant to do 1,500. Oh, there, we did the $9,000 journal entry before. That's right. I forgot. He owed 9,000, and that's what we did. We created at the beginning. And then he paid 1,500. We're just going to say he paid this one off, even though normally he would probably pay his older invoice off first, or at least pay 1,500 down on it. But we're going to say he paid this. How do we say that? I don't know, because I don't really do bookkeeping anymore, but we can say receive payment. Okay. Receive payment. And then we're receiving payment for this one, this 1,500. Oh wait, this one, this 1,500. We're receiving payment into this account, save and new. Payment received. Okay. The last one we need to do, or the second to last one, is office expense accounts payable. So that one would be a bill. We're using an accounts payable to purchase office equipment. And we're doing this from Johnny 2, remember? So Johnny 2, we're just putting it under supplies, and it was for $350. And then we just save it. And then the last one that we went over was customer prepayment. We received $1,000 from a customer, which would typically be under the sales portion. I just did a quick little journal entry, of course, so now we're going to do a journal entry to receive the money. So we increased the customer prepayment by crediting it, because crediting increases liabilities. So now we simply need to reverse that, and to reverse it, we'll debit it. Debiting it decreases liabilities. We're decreasing the customer prepayment by $1,000, and we are showing revenue, which we are calling sales, I believe. Yeah. So that's all those entries that we just went over on the spreadsheet. Now, hopefully, we'll see. Hopefully, our balance sheet and our P&L should be the same as our financial statement. So our financial statement is, here's one way to check. We just make sure the equity's right. If the equity's right, that means everything else should be in place, more than likely. 27,550. We can also just think like of that 20,550 is net income. So 27. We can go to the balance sheet first. And go to 2019, last year. 27,550 is the equity, 20,550 is net income. So we are all good. We can go to the profit and loss and make sure the profit and loss makes sense. One other thing I want to show really quick. Well, let me do this first. Profit and loss for 2019 shows the 156. Oh, and I put these in two categories. So one thing to do when you're going through the books and reviewing them is don't make things messier than they need to be. So I just made this too messy by making two income accounts. So I would simply go here and click on each one of these and just change it to income. So I'll keep one account, unless it's the, oh crap. Here, I'm not going to do all this right now. What I would have to do actually is change this product and service to map to the income account, which we're not going to go over right now. But I just wanted to say one thing when reviewing the books is you always want to make it as clean and understandable as possible. So instead of doing that, let's just say we're going to use the sales account. So we'll go to this journal entry and just change the income to sales. And that way, if we go back to the profit and loss statement, it looks a bit cleaner, right? So there you go. And this is accrual basis. It's accounting for that accounts receivable. Cash basis does not account for receivables or payables. And typically accrual is the way you want to review it for management purposes. But if you review it for cash flow purposes or for the purposes of filing the tax return, usually you want to use cash basis. So cash basis here, I don't even think changed anything. You know why? It's because the accrual, oh yeah, it changed a little bit. 20,900 instead of 2550. It changed that 350 that we did under accounts payable. So the reason it did not change the sales number right here from the receivable is because the receivable is done on a journal entry, and the journal entry is not a real way to do a receipt. You do a receivable through invoicing. So we just did the invoice or the receivable through the journal entry, so that didn't actually alter sales when we changed it from cash to accrual. So one thing we could do just to get it right is remove that or remove this receivable right here. So we're going to remove this 9 grand and we're going to set it up. Let's see. So if we remove that, we're really removing sales. So we're going to decrease this because it increased when the receivable was done, it increased sales. So this will really be 144,500. And now this journal entry equals, and what we'll do is we'll create an AR, accounts receivable, the proper way. And that way it'll adjust when it's cash or accrual. So doing a journal entry, you have to be careful. We got all this stuff right, but then we didn't think about the fact that putting in the receivable would not change the accrual versus cash basis financials. So we're just gonna go, that was a Johnny, wasn't it? Johnny, we're gonna do sales 9,000. So this will put the receivable back on the books, but it'll make it so that the revenue is only showing if it's accrual basis. So if we take this and we change it to cash, now cash is 147. So cash basis is how we want to do the actual tax return. So I said I was going to go through everything. I'm sorry, I've just been going so slow with this. I'm going to break it up in 2 videos just because it's already been 40 minutes and you might not want to watch this all at once. And I think it'll be easier to set up under 2. So my next video is going to go over what to do, how to get Maria from starting a business to setting up the books to inputting her books to filing a tax return and subsequently trying to do some tax strategy. So we're going from starting a business to tax strategy, and that's kind of the full spec. There's more to it than that, but that's 90% of the financial part of operating a business, besides the managerial accounting. Just the tax and the administrative part is setting up the books to filing the tax return to tax planning. So we will do that next. Thanks for bearing with me through this long and grueling tax video, accounting video, bookkeeping video, whatever you want to call it. Talk to you soon.